Good morning. It is Tuesday, June 9th, 2026. This is your deep dive daily briefing. I am your anchor, delivering a comprehensive analysis of the pivotal events that have defined the last 24 hours. Today we will cover the latest global developments across 7 key pillars: world, economy, finance, stock, technology, energy, and logistics. We begin our broadcast on the world stage, where the strategic and military posturing surrounding the Middle East peace process has entered a highly delicate phase. The fragile ceasefire that took effect on April 8 to halt fighting involving the United States, Israel, and Iran is currently facing one of its most serious tests. Following recent escalations where Iran launched missile barrages toward Israel, Israeli forces struck several military targets in Iran in retaliation. United States President Donald Trump has actively intervened in the diplomatic sphere, asking both sides to stop shooting and reportedly urging Israeli leadership not to retaliate further while pressing Iran to resume negotiations. This persistent geopolitical friction is fundamentally altering domestic security protocols in allied nations. In Canada, a national intelligence watchdog has formally warned that the Canadian Security Intelligence Service risks stereotyping foreigners during security screening processes, highlighting the growing domestic complexities generated by heightened global threat levels.
Transitioning from the tense geopolitical landscape to the broader global economy, the macroeconomic picture presents a striking divergence between resilient growth and stubborn inflation. The United States economy continues to display surprising underlying momentum, with the May 2026 jobs report indicating that the nation added 172,000 jobs, significantly beating forecasts of 85,000. Despite this strong hiring activity, particularly in the leisure, hospitality, and healthcare sectors, wage growth remained tame at 3.4% year-over-year, suggesting the labor market is improving without stoking an immediate wage inflation spiral. However, the broader inflation narrative remains highly restrictive. The April Consumer Price Index came in hot, with headline inflation rising 3.8% year-over-year as the conflict in the Middle East continued to put upward pressure on prices. Looking globally, economic activity strengthened this year, driven primarily by capital spending from the business sector, but this growth is uneven. While the United States and parts of Asia benefit from artificial intelligence infrastructure investments, Europe is generating less domestic growth and appears heavily exposed to the macroeconomic effects of the recent energy shock.
In the realm of finance, this environment of structural inflation and regional economic divergence is forcing a profound reassessment of risk and policy paths across international capital markets. Global markets are navigating an increasingly uneasy mix of geopolitical risk and shifting macro fundamentals, where the escalation in the Middle East has reintroduced a stagflationary impulse. The market pricing of central bank moves has completely reversed throughout the quarter, as previous expectations of rate cuts have been scaled back and replaced by concerns that monetary policy must stay restrictive for much longer. At the April Federal Open Market Committee meeting, the Federal Reserve voted to hold the federal funds rate steady at a range of 3.5% to 3.75%, with internal divisions becoming apparent as one governor dissented in favor of a rate cut while 3 other members voted in favor of acknowledging mounting upside risks to inflation. Consequently, fixed income markets have been anything but sanguine. Yields on United States Treasuries rose to their highest level in more than a year at the front end of the yield curve following the strong jobs report, while long-end government bond yields in advanced economies have continued to grind higher to multi-decade levels, reflecting the combined pressure of inflation risk and massive fiscal supply.
Turning our attention to the stock markets, global equities have remained surprisingly buoyant, yet they are increasingly characterized by extreme concentration and sudden bouts of regional volatility. The artificial intelligence investment cycle is functioning as a macro-level stimulus, supporting strong earnings growth that is projected to continue through 2027. However, this dependency is creating severe risks in highly concentrated markets. South Korean stocks, often viewed as the poster child for artificial intelligence concentration risk, tumbled more than 8% and extended a 3-day decline to 13.5% as investors pulled back from the bets that have fueled the global bull market. The benchmark index managed to narrow its drop later in the session as memory semiconductor makers Samsung Electronics and SK Hynix rebounded from their lows. Financial analysts warn that while the broader semiconductor sector is not currently in a bubble, It is trading at a premium of 28 times forward earnings compared to a historical average of 19 times, prompting institutional investors to take profits in storage companies that have seen unsustainable margin expansions.
Focusing entirely on the technology sector, the structural push to sustain the artificial intelligence supercycle continues to drive both capital expenditure and broader equity gains. Technology has accounted for an astounding 76% of global equity gains in the second quarter to date. Capital spending by hyperscalers has risen sharply and is expected to continue growing, functioning as a primary economic stimulus that drives demand across global supply chains and boosts industrial activity. This infrastructure rush is fundamentally reshaping adjacent industries, leading financial institutions to upgrade utility companies as they become structural beneficiaries of the artificial intelligence cycle through surging electricity demand and data center expansion. Nevertheless, wealth managers are calling for valuation discipline, cautioning that growing signs of market exuberance and an anticipated massive supply of initial public offerings from major innovators like SpaceX, Anthropic, and OpenAI risk creating a significant drag on the broader equity market in the second half of the year.
As we look at the energy markets, the structural fallout of the Middle East conflict continues to dominate pricing dynamics. Global crude oil remains underpinned by renewed regional tensions, and the recent April inflation report confirmed that energy prices rose by an alarming 18% year-over-year. The fallout from the Middle East conflict has broadened significantly, transmitting a stagflationary shock that flows through to transport, food, and fertilizer costs. Despite these macro-level pressures, there is some localized relief for consumers in the United States, where domestic gasoline prices are projected to decline for a fourth consecutive week. Meanwhile, gold, traditionally a safe haven asset, broke key support levels recently due to rising inflation and rate fears, leading analysts to tactically downgrade the precious metal as its price action remains range-bound and the stronger United States dollar reduces near-term upside potential.
Finally, we examine the logistics and supply chain networks that serve as the vital arteries of international commerce, which are currently absorbing the compounding damage of synchronized geopolitical shocks. Global conflicts and supply disruptions have contributed to massive volatility in energy markets, creating severe uncertainty across the global aviation sector. In response to elevated jet fuel prices that are significantly increasing operating costs, the Government of Canada announced the launch of the Liquidity for Airline Sector Resilience Facility, a new loan program offering up to $150 million in repayable liquidity support to eligible domestic airlines. This targeted, temporary action coincides with the Canadian government temporarily removing the federal fuel excise tax to reduce costs by 4 cents per litre on aviation fuels. On the maritime front, a reopening of the Strait of Hormuz is considered the most critical risk catalyst for the global logistics network. Financial analysts project that a permanent normalization of the strait would be the main trigger for a broadening of market participation, significantly lowering shipping and insurance premiums that have surged as trade routes remain disrupted.
In summary, the global landscape is defined by the fragile April ceasefire facing serious tests in the Middle East, while the United States economy demonstrates resilience with a 172,000 job gain alongside a hot 3.8% inflation print. Financial markets are repricing risk as the Federal Reserve holds the funds rate at 3.5% to 3.75%, driving Treasury yields to multi-decade highs. The stock market remains supported by the artificial intelligence supercycle despite a severe 8% tumble in South Korean equities, while the technology sector braces for a massive wave of initial public offerings from major industry leaders. Energy markets remain elevated due to Middle Eastern tensions with prices up 18% year-over-year, forcing the Canadian government to launch a $150 million liquidity facility to insulate its aviation logistics network from soaring fuel costs. Based on the current trajectory of these events, I predict that the combination of sticky 3.8% headline inflation and the escalating artificial intelligence capital expenditure cycle will force the Federal Reserve to completely abandon any plans for a rate cut for the remainder of 2026. The fact that hyperscaler infrastructure spending is actively stimulating the broader economy means that underlying corporate demand will remain exceptionally firm, neutralizing the cooling effects of high interest rates on the consumer side. Unless a comprehensive, permanent peace treaty is signed to immediately reopen the Strait of Hormuz and crush the 18% inflation in energy prices, central banks will have no choice but to maintain a highly restrictive monetary posture well into the winter to prevent the stagflationary impulse from permanently unanchoring global price stability.